Here to talk us through all of it is Michael Landsberg, the Chief Investment Officer at Landsberg Bennett Private Wealth, and Mike Pond, Head of Inflation-Linked Research at Barclays. Mike Pond, I'll kick it off with you. How much near-term inflationary pressure do you anticipate from all of this?
Well, so far, the only increase we've seen is to uncertainty, not to inflation itself. We could still be seeing tariffs as a pure negotiating tool, in which case we wouldn't see any or very, very little tariff-induced inflation that hits the consumer. On the other hand, if we get 25% tariffs on Mexico and Canada, those are likely just an opening round to a true global trade war that could push up inflation by 100 basis points or more. So inflation uncertainty has risen dramatically, but we actually haven't seen anything come through in inflation just yet.
Well, just to dwell on that for a moment, I think it was Larry Lindsay on the program the other day who said he thought this was all a chess game with Mexico and Canada to actually kind of get us to come to an agreement, present a united front contra China. Putting all of that aside, the only tariffs that have gone into effect right now are on steel and aluminum. Is that right?
That's right. Well, plus the 10% on China.
Right.
But even we saw tariffs imposed on China in Trump 1.0, but they weren't big enough or broad enough, either on a goods perspective or a country perspective, that it really hit the consumer. Tariffs can be avoided, if you will, or at least dampened through a currency appreciation or absorption in corporate margins. So there are ways where even if we do have tariffs, if they're not big enough or broad enough, they won't actually hit consumer inflation.
Yeah, the CPI report was pretty nasty yesterday. And again, maybe the PPI today tells us, okay, PC is going to be 3/10 or 4 instead of 5. I don't know, Mike Pond. The trend is not great to kick off the year, and that's why any little wiggle on the tariff front or for other reasons presents a bit of a problem.
Yeah, I mean, when we look at the underlying components of CPI that surprised to the upside yesterday, we're not worried about the trend in inflation accelerating again. And we don't think the Fed should be, and we don't think the markets are. If we look at the move in break-evens yesterday, yes, break-evens went up, particularly at the front end. But if we look at forward inflation expectations, they barely budged. So in other words, the market said, yes, we got a higher inflation print, but it means nothing for February, March, and April. At least not what we didn't already know. So it was things like used cars or lodging away from home, so hotels or airline fares. Those are traditionally very volatile components, not indicators of the underlying trend. So we're not worried that yesterday's print leads to higher inflation for the rest of this year. In fact, the translation into PCE, which is more important for the Fed, and we'll get this later this month, indicates that the year-over-year core PCE rate should fall from 2.8% in December to 2.6% in January. That's welcome news for the Fed. It's sufficient, but far from it's necessary, but far from sufficient for them to cut. They're on hold for now. They're looking for data that tells them that inflation is back to 2%. They're not getting it yet, but it doesn't mean that they can't get it in the months ahead.